The Federal Reserve does not set your car loan rate. The Fed does not set your personal loan rate. The Fed does not set your credit card rate. So why does every single one of these rates move the second the Fed opens its mouth? I am Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. Let me walk you through something most people never connect. The Fed controls one rate, just one. It's called the federal funds rate, and is the rate banks charge each other for overnight lending. That's it. That's the lever. But that one lever moves almost every consumer loan rate in the country. Here's how the dominoes fall. The Fed sets the federal funds rate. Banks then set their prime rate about 3 percentage points above that. And from there, lenders price your personal loan, your auto loan, your private student loan, and your credit card off the prime rate. Now think about what happened between February 2022 and August 2023. The Fed raised the federal funds rate from 0.08% to 5.33%. That's a 5-point jump in 18 months, and every consumer loan in America went up with it. So what does this mean for you today? The average rate on a 2-year personal loan is 11.4%. That's down a little from the high of 12.49% in early 2024, but barely. A new car loan, 7%. A used car loan, 11%. A federal student loan for this school year, 6.39%. 5 years ago, that same student loan was 2.75%. Let me say that again. A college student borrowing money today is paying more than double the rate a student paid in 2022. Same school, same loan, just a different year. And here's the part nobody tells you. The Fed has cut rates a few times in 2024 and 2025, but consumer loan rates have barely moved. Why? Because lenders are slow to lower rates and fast to raise them. That's not a conspiracy. That's just how the business works. So if you cannot control the Fed, what can you control? You can control 3 things: your credit score, your debt to income ratio, and your strategy. Your credit score is the single biggest lever you have. A 740 score and a 640 score on the same loan can be a difference of 4 or 5 percentage points. On a $40,000 car loan over 6 years, that's real money. Thousands of dollars, sometimes more than the down payment. Your debt to income ratio matters too. Lenders want to see your monthly debt payments at or below 35% of your income. Get above that and the rate jumps. Get above 43%, and a lot of lenders will not approve you at all. And then there's strategy. This is where most people miss the point. They focus on the rate. They shop the rate. They negotiate the rate. They lose sleep over the rate. And they completely ignore the bigger picture. Strategy beats rate always. Here's what that actually means. Let me give you a generic example. Say you have a car loan at 7%, a credit card at 22%, a student loan at 6%, and home equity sitting there doing nothing. Your blended cost of debt across all those is probably north of 9%. You can chase a slightly better personal loan rate all day long. But if you not look at the whole picture, you are rearranging deck chairs. What if instead you looked at your household blended interest rate? What if you used the equity in your home and restructured your debt to bring the blended cost down by 2 or 3 points? On $80,000 of consumer debt, that's $1,600 to $2,400 a year every year for as long as the debt exists. That's the difference between shopping a rate and shopping a strategy. So here's what I want you to do. Before you take out your next loan, before you sign anything, before you say yes to a dealer or a credit card offer or a personal loan ad, do 3 things. Pull your credit report and know your score. The easiest way to do that with no hit to your credit is at rsrlinks.com/FICO. That's rsrlinks.com/FICO. And that's a source that does not sell your data. Add up your monthly debt payments and divide by your monthly income so you know your real DTI, debt to income ratio. And look at every loan you have side by side and figure out your blended interest rate. We have a calculator that does that math for you in about 2 minutes. You give it your balances, your rates, and it tells you exactly what your household is really paying. When you have those 3 numbers in front of you, your FICO, your DTI, and your blended rate, you can actually make a decision. Without them, you are just guessing. The credit monitoring, the budgeting tool, the asset tracker, the blended rate calculator are all in one place. You have to go to rsrloans.com. Now, you can go to rsrlinks.com/keysteps. That's rsrlinks.com/keysteps. No cost, no obligation, just the numbers you need to stop reacting to the Fed and start running your own playbook. The Fed will do what the Fed does. You can't change that. But you can change what every Fed decision costs your household. That is the whole game. I am Ron Siegel, your certified liability advisor. Thanks for listening to Your Credit Matters, brought to you by rsrlinks.com/debt-free, rsrlinks.com/debt-free.